Hey everyone, welcome back to Corporate Decoder, the place where we translate the corporate jargon into something that actually makes sense, and maybe tonight we'll uncover if Mark Precious Metals Incorporated is really striking gold or just holding on to tarnished metal. So, Mark Precious Metals Incorporated dropped their latest quarterly report, and what we're seeing is a company dealing with some serious shifts. Revenues are up significantly, but profits are struggling. Let's dive in and see what this really means for their business. And hey, before we get too deep into the numbers, if you enjoy getting these kind of straightforward breakdowns of financial documents, make sure you hit that subscribe button. Also, we've got a thriving community over on our Discord server, linked in the description below, where we break down these filings even further, and you can ask your questions directly, so go check that out. Alright, let's tackle this quarterly report from a Mark Precious Metals Incorporated for the period ending the 30th of September 2025. Right off the bat, the company is showing a massive jump in revenue, almost 36% higher than the same time last year, hitting a staggering $3.68 billion. This sounds amazing, doesn't it? But hang on, not everything that glitters is gold. While revenue is soaring, their gross profit, which is what is left after you pay for the stuff you sold, only increased by about $1.3 million. That is a pretty small jump compared to the revenue surge. What does this mean? Well, it means the cost of sales, what they have to pay for the precious metals themselves, has eaten up most of that revenue increase. Think of it like this: if you sell 100 widgets for $10 each, that is $1,000 in revenue, but if it costs you $9.5 to make each widget, your profit is only 50 cents per widget. A Mark is selling a whole lot more widgets, but their profit margin per widget isn't growing nearly as fast. This is a classic sign of tough market conditions where the cost of raw materials, in this case, gold and silver, is rising fast, or they are having trouble passing those costs on to customers. And it gets more interesting when you look at their operating expenses, selling, general, and administrative costs, which include things like salaries, advertising, and rent, almost tripled in just 1 year, jumping from $26.6 million to a whopping $59.8 million. What happened here? The filing mentions acquisitions. They brought in Spectrum Group International Incorporated, Pinehurst Coin Exchange Incorporated, and AMS Incorporated during this period. While acquisitions can be good for long-term growth, integrating new companies often means a big increase in expenses in the short term. All of this put together, the massive revenue increase, but the struggling gross profit and the skyrocketing expenses has led to a net loss for the company. For the 3 months ending the 30th of September 2025, a Mark Precious Metals Incorporated reported a net loss of $971,000. That is a huge swing from the same period last year when they actually made over $8.4 million in profit. So while they are selling more, they are currently losing money. Let's look at the actual volume. They sold more gold, a key indicator of business activity, about 10% more ounces. But, and this is a big but, they sold significantly less silver, almost half as much. This could be due to market demand shifts or strategic choices to focus on gold. The real kicker though is the price. Gold prices went up nearly 39% and silver prices jumped over 40% in the same period. So even though they sold less silver, the higher price made their revenue look much better, but it also means they likely paid more for that silver in the first place, squeezing their margins. Now, let's break this down by their different business areas. Their wholesale segment is the biggest revenue driver, and it saw a solid 26.5% increase. This is where they sell in bulk to dealers. Their direct-to-consumer segment, where they sell to individuals online, actually saw a massive revenue jump of 77%. This is likely fueled by those recent acquisitions like JM Bullion Incorporated. But look at the profit margins within these segments. The wholesale segment's profit margin actually went down a bit, even though its revenue went up. This suggests they are making less profit on each dollar of wholesale sales. The direct-to-consumer segment, however, saw its profit margin improve, which is a good sign, even with those higher operating costs due to acquisitions. Beyond metal sales, a Mark Precious Metals Incorporated also has a secured lending business. This segment focuses on making loans backed by precious metals. The number of outstanding loans actually decreased quite a bit, about 25%. This means they are either making fewer loans or customers are paying them back faster. Interest income from this segment also dropped. One thing that really stands out in the financials are these acquisition-related contingent consideration liabilities. Basically, when they buy companies, they sometimes promise to pay more money later if the acquired company hits certain performance targets. These are like bonus payments tied to future success, and the value of these promises can change. The report shows that the value of these future payments has decreased. This can be good if it means they will pay less, but it could also signal that the acquired companies might not perform as well as initially expected, which is a potential risk flag. It is also worth noting how they value their assets. Mark Precious Metals Incorporated relies heavily on Level 1 and Level 2 inputs for fair value measurements. This means they primarily use readily available market prices for things like their inventory and derivatives. This is generally good, as it means their valuations are based on real market data and not just internal guesses. However, for things like those contingent acquisition payments, they are using level 3 inputs, which are based on their own estimates and assumptions, making those valuations more subjective. Looking at their finances, Mark Precious Metals Incorporated has a significant credit line, their trading credit facility, which was recently amended and increased to over $422 million. This is their lifeline for buying and selling metals and funding their lending operations. They've been using this facility quite a bit. Their cash flow from operations swung dramatically. Last year, operating activities used a lot of cash, over $127 million. This year, they generated almost $195 million. This huge positive swing is mainly due to changes in how they manage their inventory and other assets and liabilities, probably meaning they collected more cash from sales and had less cash tied up in inventory. Now, looking at all of this, Mark Precious Metals Incorporated is definitely a company in transition. They are aggressively acquiring other businesses to expand their reach, especially in the direct-to-consumer space and in numismatics, which is the study and collection of coins and currency. This is a smart strategy to diversify beyond just wholesale trading. The revenue surge driven by higher precious metal prices and acquisitions is impressive. However, the widening gap between revenue growth and profit growth, along with the significant increase in operating expenses, are red flags. It shows that integrating new companies and managing the rising cost of goods is a major challenge right now. Their profit margins are thin, and any hiccup in the market or in their acquisition integration could really hurt them. The decrease in loans within their secured lending segment is also something to watch. While it's a smaller part of their business, it is a source of stable interest income. The fact that it's shrinking could indicate either a tightening of lending standards or a potential slowdown in that market. Overall, Mark Precious Metals Incorporated seems to be playing a big game of expansion. They are betting on the long-term growth through acquisitions and diversification. But right now, the short-term results show significant pressure on profitability. They need to prove they can manage these new acquisitions efficiently, control their spiraling expenses, and translate their massive revenue into actual profits. It is a high-stakes gamble, and investors will be watching very closely to see if they can pull it off. What do you all think? Are these acquisitions a smart move for the long haul or a costly distraction? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more in-depth looks at corporate filings. And don't forget to join our Discord community linked in the description for even more insights and discussions. Thanks for watching Corporate Decoder, and we'll see you in the next one.